Ladies and gentlemen, yes, there are BOGOs in the stock market. On today's video, I want to talk about what a BOGO stock looks like, the patterns I look for, and my top 5 buy one, get one stocks this summer. And stick around to the end because you're going to want to see the receipts. So let's go shopping. Hey everyone, Tom Gentile here from Patterns and Profits, and today I want to talk BOGOs. Now, if you first timers are here, welcome to the channel. If you find this information useful, I only ask that you like and subscribe to Patterns and Profits. Also, I'm not an investment advisor, and past performance does not guarantee future results. So let's go ahead and get started. Now, just to give you some backstory here, I came up with this video over the weekend while I was shopping at my local Publix supermarket here in Florida. Now, if you don't know, Publix is known for 2 things more than anything else. Number one, that big scale. You know, the one at the front of the store where people weigh themselves and then they feel like they're fat shamed afterwards. That's one thing. But the more important one is number 2, the number of buy one, get one free that they offer in the store, which got me thinking, you know, a BOGO is basically getting items for an average of 50% off their market price. So if that's the case, can I find BOGOs in the stock market? And if so, how can I get them? Well, I want to talk about that with you right now with my top 5 BOGOs this summer. So let's go ahead and get started with number 5. And I'm talking about Tractor Supply Company, that is TSCO. So Tractor Supply Company was a $55 stock back at the beginning of the year. It's fallen all the way down to 30. So buy one, get one is basically a half off sale, because that's another way of describing what a buy one, get one is. Then I'm looking to get this stock for $15 a share. Well, how can I do that? Well, one of the things I could do is just simply put a limit order in and buy the stock, put a limit order in for 50% off. Now, that's going to need to be placed as a good till canceled. And so what that means is that, you know, there's not that possibility that I could get filled on something that's $15. You know, I want it for $15 when it's selling for 30. So that's one thing we could look at. So, you know, going back to this, that means that the stock's going to have to drop even more. It's going to have to drop in half again for me to get that stock at $15. But what if there was an alternative way to do this? There is an alternative way to do this. And for option traders, it means selling puts. Now, selling puts means that I'm actually going to get paid to create a contract. And the contract means that I will buy the stock at a certain price by a certain expiration date, by a certain time in the future. I'm going to get paid for that, right? So I'm obligated. So why not obligate myself to buy the stock for a much lower price than we're talking about today? That's what selling puts is all about. So I went to take a look and see what the TSCO puts were selling for. And with the stock trading at $30, I want to have the right to buy it at $15. Well, I can create that obligation to buy it at 15 by selling the 15 puts in the future. And these 15 puts, which are out over a year into the future, I'm going to get paid $1.70 per share. That's $170, all right, to sell this option, which obligates me to buy the stock at $15 a share. Sounds pretty good. All right, let's take a look at number 4. Number 4 is METU. That is the Meta stock, all right, Facebook stock, but it's the 2X Facebook stock. So this is the leverage 2X. What's been going on with Facebook? Well, earlier this year, we're talking about highs on METU at near 40. Well, they dropped recently in 6 months down to half the price. They've started to jump back up again, but with the stock trading around $28 or so, you know, what is it going to take for me to obligate myself at this particular stock? Well, guess what? I can sell the METU puts with the 15 strike. That obligates me to buy METU at literally half the price it's selling at today. I'm going to get $178 per contract to sell this put option. Now, this put option expires on January 15th, 2027. So that's only 186 days from now. 6 months, I'm holding this, and I'm going to get $1.78 to hold this at a $15 price tag. What I'm doing basically is structuring trades to create an odd or increase the odds in our favor. And with that, it brings me to number 3. State Street Bank, symbol STT. Now, this one's doing something the other two that I've showed you has not. It started out the year around $125 a share, came down to around 120, but look where it's at now. It's now bouncing off of $180 a share. Okay, so what's half of 180? Well, 90 is half of 180, but the 95s, which are just above that, just a little bit less than 50% off. Well, guess what? I can sell this BOGO option, and I can collect $253 per contract. That obligates me, one contract obligates me to 100 shares of STT, but not at the market price, all right? Not at the price of near that $180 a share. This is obligating me to a price of near half that, or $95, right? And again, like I said before, there's no guarantees that the stock is going to go up or sideways or down. But what we're doing is we're taking the stock's volatility of its past. We're incorporating potential future volatility and therefore drawing a cone. Number two is HCA. That's HCA Healthcare. Earlier this year, HCA was trading at a whopping price of $550 a share, but it's now come down to just above $400 a share. What's my BOGO price here? Well, it's half of 400, which is 200. So what can I get paid for? How much can I get paid to put myself out there to potentially buy the stock at $200 a share? Well, this particular BOGO option is offering the January 21st, 2028 contract for $3.50. That's $350 for one contract to, again, put myself in a position to buy HCA for half off, $200 per share, right? Most importantly, what I look at is I look for payouts. If I'm going to obligate myself to buy a stock, if I'm going to obligate myself to buy a stock at any price, I want to be paid for my work. I want to be paid for sitting and waiting. Whether the stock goes up, whether the stock goes sideways, whether the stock goes down, I still get paid. I look at something called the payout chart, and this is where we take a look at options, and we look at the options pricing models to determine which options have the most expensive payouts. And that's what you're looking at, folks. You're looking at options that have the most expensive payouts right now out there. And that brings me to number 1. The number 1 stock of the 5 that I'm looking at for BOGOs, for deeply discounted prices, is Meta Platforms. Number 1, META, all right? Formerly called Facebook, Meta Platforms hit a high for 2026 above $730 a share. It came back down into the low 500s, but most recently is trading back up again in the high 600s. Here's what I'm going to be paid, all right, between now and about a year from now to set myself up by selling this BOGO put to obligate myself to buy at $330, which is half price, $613 for this particular contract, again, to buy the stock for $330. Now, adding it up all looks like this. My Tractor Supply puts, $170. METU puts are $178. STT puts, I could sell those and collect $253 per contract. HCA, I could sell for $350, and Meta, $613. That all 5 of those together equal income, total income of $1,564. And again, that's per contract. That's for one contract of each of these. Now, some questions that I ask myself, and you should be asking too. How much money would I need to sell these BOGO options? Well, that all depends. That can be anywhere from 20% of the stock price all the way up to what's called cash secured, which is 100% of the stock price. But it's the stock price you're willing to buy, right? Not today's price, but the BOGO price, the price you're willing to buy for. Question number 2, are there any ways to reduce the cost and risk of the strategy? There are. Other than what we've just shown you, you can go in and spread your options, and that will dramatically lower the cost, and it dramatically lowers the risks. But you don't get the BOGO stock if it goes down to your strike because the spread covers that. Number 3, these all have an average of a year before the option contracts expire. How do I shorten this time frame? How do I get contracts? Can I find contracts on discounted stocks that allow me to get in for not just the lower prices, but I have less of a time frame that I can collect those premiums for? And the answer is yes. All right. We put those together, and I look at those in what I call rules-based trading. It works, where I spot the opportunity, I sell that high probability put, I plan, execute, and manage, and then I rinse and repeat. And I do this strategy on a weekly basis. If you want more details on that, I have a detailed video right above me. There's a QR code. You can click on that QR code, or you can also click on the link in the description. That'll give you a video that shows you exactly how I do this, as well as a special offer if you want to come and do this with me on a weekly basis.